My name is Alex Klokas. I am the managing partner at Kyber Capital alongside Mr. AJ Scaramucci, and I thank everyone for coming here today. We have a great group of panelists. We have a lot of them, and the format that we're going to take here is we're going to do quick 60-second introductions, and then we're going to actually have conversations. What that means is we're going to try to avoid boring run-on kind of diatribes. We're going to actually try to discuss some things that are interesting and stimulate some new ideas as it relates to what institutional adoption for crypto actually means. So let's start with Mr. John Shaffer, if you'd like to give an introduction.
Hi, everyone. My name is John Shaffer. I am the CEO and co-founder of Fission Labs. We're focused on taking late-stage venture portfolios, tokenizing them, and allowing them to trade on DeFi rails. Previously, I was at Point72 for the last 5 years as both a public and private market investor.
Hi, everyone. I'm Dima, Romanov, the co-founder and CEO at Layer N, and we are building a new blockchain. The goal for us is to build a blockchain which has no difference in terms of performance, latency, throughput with Web2 applications, and really the goal is to bridge this gap of what is possible to build on-chain versus off-chain, and that's where we think we can unlock a massive difference and a ton of new applications which can actually become a viable alternative to traditional finance.
Afternoon, everybody. My name's Nick. I'm the co-founder and CEO of Concrete. We provide what we think is an abstraction layer from the complexity of DeFi products that over time will provide institutional grade solutions for people to invest and access. Similarly, John, before I started building in crypto was at Point72 and in a former life as a physician in the UK.
Hi, everyone. My name is Ryan Zurrer. I've been in crypto for going on 12 years now. My company, Dialectic, is a multi-strat fund. Our primary activity is driven by a on-chain yielding machine that we call Medici. And Medici automates the entire process of risk management and opportunity selection, deployment and execution on-chain, as well as an early warning alerts mechanism. And we've also added a compelling insurance product. We yield in ETH, in USDC, and most recently in Bitcoin. And to our knowledge, we produce the highest yields in the space by a significant margin.
Hello, everyone. My name is John Belitsky. I'm a co-founder at Balcony Technology Group. We bring government records onto the blockchain, in particular real estate records. I'd also like to note that we have partnered with the University of Wyoming, which we're very proud of, to start bringing this technology into the state of Wyoming. The end goal here, since we're discussing institutional capital, is that we can create an actual atomically tradable real-world asset that exists on-chain with government endorsement for this product.
Thank you all. So some of these panelists we have here, they've deployed hundreds of millions of dollars as an institution. They've raised hundreds of millions of dollars from institutions. But the problem is we're using this phrase institution or institutional grade super liberally. There's no kind of agreed upon definition. So everybody actually means different things when they say that. Institutional grade in the East, very different than institutional grade in the West. And so maybe, Nick, I'll start with you. When we use the word institutional grade, how do you think about that? What has your experience been?
I think historically we have a really good understanding of what institutional capital looks like in traditional finance. It's well defined, it's well regulated. There are certain accesses and rights that everybody is afforded by registering, passing certain qualifications, having certain AUM. We understand very, very well exactly what the tiering and tranching of that might be. When it comes to kind of digital assets more broadly, realistically, we don't have any framework for that. There are very sophisticated firms like Ryan's, which are what I would consider kind of tier one institutional fund managers, allocators, and investment strategists. But when it comes to building a kind of the network or the kind of application layer, you often end up speaking to somebody who has, just by default of being early on in the space or being dogmatic about their religious belief and accruing as much BTC or ETH as possible, by default qualifies as an institutional pool of capital because it is, as a builder in the space or a founder or a business owner within crypto and digital assets more broadly, it qualifies as a certain sum of capital that can move a company forward with some fraction or partition of that amassed wealth. That being said, the East versus West conversation is obviously an active topic of conversation. I, like many other founders in the space, will spend a huge amount of time out in Asia, particularly where there is a certain different lens on the quality of the asset class more broadly. It is already accepted as a net new area of assets, asset management opportunity, and kind of investment grade. But certainly from the West, we're trying to find ways to horseshoe it in a little bit to things that we already have. And I think there's some fragility in that approach. And there's also some nuance in how we can be better at defining what institutional capital looks like in the West. The East is a little bit more based on dollar amount, and plus a small cohort of very, very sophisticated groups who are running strategies from there.
And Nick, I mean, I know you've kind of been on the road for many months. You've raised hundreds of millions of dollars. If you can share, like, how much of that has come from the East, roughly, how much of that has come from the West, and why? Why is that?
I will tell you that, candidly, most of it, almost all of it, comes out of the East. Why is that? I think as somebody building in the space, my time is finite, and you have to optimize for the most willing participants. If you're selling cars, you're not going to go to a place where there's no roads. And that's the way we think about selling our opportunity. There are very limited roads for us to put cars on in the road, in the US right now. When we think about raising and deploying liquidity, there are very, very many more willing participants and purchasers in the East. And it all comes from a mindset perspective, in my opinion.
Ryan, do you think that's going to change anytime soon?
It's been my experience over my history in the space that the available risk capital in Asia has been fairly aggressive. That is in part because of a cultural input of just a desire for flight capital. And so I think John probably experiences this as well. When you go and meet with a Chinese institution, they'll kick the tires, but they'll make a decision really, really quickly and deploy that day on chain. You go and talk with an American institution, the idea of them deploying on chain is fully off the table. And then the process of getting to yes is just much more protracted.
Yeah.
And that's not even considering Europe, which is a whole other length of time that is really unattractive for entrepreneurs today.
Does anyone on this panel think that's going to change soon or have any different opinions on this?
I mean, my space is unique. When we're talking about real estate, for example, there is zero East or West institutional capital that is in this space in a meaningful way on chain because the primitives do not exist. That's literally what we're building. Almost unfortunately, I mean, it would be great if we could just build on an existing graph. It would be a lot more profitable, a lot quicker, but it's not there. I think that once we are able to instantiate a real on-chain atomically settable asset, then we will see both East and West money run into the United States, and they'll move quickly once we get these primitives in place.
Let's maybe talk about these primitives. We all know Bitcoin is king. Institutions, maybe they're buying Bitcoin. Is that really institutional adoption of crypto? I think you could argue either way. Obviously, most of the primitives seem to be being built predominantly on Ethereum. Ryan, I know that most of the work that you've done in the past has been on Ethereum. You're maybe moving into Bitcoin. How do you see all of that developing?
Yeah, so it's interesting that we're seeing that the ETH ETF is not getting quite the traction that we expected, and people would at a first glance say, well, that just means it's not as attractive to institutions. That's not really the case. Institutions are smart money. They'll go to where the yield and the returns are, and institutions are deciding to go on chain and pursue that staking rate or more compelling yielding rates that are natively available in Ethereum and other ecosystems. Whereas the opportunity cost of holding Bitcoin on a Trezor or holding IBIT with BlackRock is basically negligible. The opportunity cost of holding the Ethereum through an ETF or Ethereum on chain where you can stake or yield is enough such that institutions will go through the friction of holding it on chain. And that's really the story here, not that it's not as popular.
Does anyone here think that we're going to start to see a robust ecosystem being built on top of Bitcoin that attracts institutional investors?
I think there's certainly been a lot of capital deployed from the private markets to explore that in the last 12 months.
Yeah.
I think one of the more interesting trends over the next kind of 90 to 100 days is net new Bitcoin standards that are finding their way. You know, today is a pretty significant day in terms of the go live for Babylon, which some of you may be familiar with, but very, very interesting mechanism by which we're starting to distribute some of the latent Bitcoin that has been kind of sitting on the sidelines. I think Ethereum has been the best way to secure yield for people with significant depth over the last couple of years. Very intrigued to see whether this net new inflow of novel BTC standards and a lot of private investment going into the ecosystem to build on that layer yields a durable outcome that can compete with somewhat you could maybe hallmark as the builders side of the table, which has been the Ethereum ecosystem for the last couple of years.
Yeah.
Yeah. On the other side of that, what we see on the ground is that the native yield in Bitcoin is not very compelling.
Yeah.
Low single digits. And it's actually far more compelling to go and convert that into USDC or another asset, go and capture compelling ultra high yields, and then just perp it out back to Bitcoin. So the dirty little secret of the Bitcoin yielding ecosystem is that most of it's happening on Ethereum. And I don't see that fundamentally changing anytime soon.
Dima, what do you think? I mean, you've spent a lot of time building a layer 2 on top of Ethereum, specifically designed, at least in some ways, to attract institutional capital. How are you thinking about this?
Yeah, I generally think that we're in a way approaching a point in time in an infrastructure where it becomes less and less relevant where your tech stack is, because you can start to build a roll up on Bitcoins. There's like a lot of bridging infrastructure to move it around. And primarily it comes down to like being able like to get those yield bearing assets to different infrastructure places. So I think like the competition like in the next few years will be more about where the applications will reside, where the smart contracts will reside, because the friction for someone to onboard to Ethereum rollup, Bitcoin rollup, or even like Solana or any kind of blockchain will decrease over time. But the question is like, how can you build an application which provides the best experience, both like financially, like complexity wise, like for people who want to capture the yield, who want to capture and use those products down the line.
So maybe let's do kind of a quick response here. And I'm curious. Let's say we fast forward 5-10 years. Institutional adoption, whatever that means, is in full swing, baby. We've got everyone on here. They're doing stuff. Where are they doing it? John, where do you think they're doing it? On Ethereum? Dima?
My answer would be layer N, but I guess proxy of Ethereum. But yeah, I think it's going to be wherever the best applications are, regardless of what chain they're built on.
Nick, what do you think?
Ethereum ecosystem.
You know, when Olaf and I built out the early days of Polychain, we used to always say that we believe in the Polychain future of Web3. Otherwise, we would have called it a different, a different name. And inevitably, there will be a multitude of chains. It will not be the hundreds that exist today, but somewhere between probably a half a dozen and 2 dozen sort of general purpose chains, and then a series of sort of side chains or L2s and L3s that have very specific use cases for gaming or for IoT or otherwise.
What do you think?
I have a slightly different view. I actually think that we're going to have many orders of thousands of functional quality chains. I think there will be EVM chains. So I guess the short answer would be Ethereum in the abstract. But I also think, Dima, you may take some solace in this comment. I don't think that the layer 1, Ethereum or Bitcoin, is going to matter significantly in 5 years for people who are building, particularly things like what we're building at Balcony with the University of Wyoming, which is real world assets. I don't really care about Ethereum because that's not the asset that I'm trading. Whereas for you gentlemen, it is all that matters, right? So I think I have a much more fractured view of what this looks like.
I mean, this is supposed to be Solana summer, right? But nobody's mentioned anything about Solana. Anyone have any strong opinions? Where does institutional adoption in Solana fit in anyone's mind here?
I think there's, the recent comment by Larry Fink, kind of what internally we call Emperor Fink, who we take a lot of signal from, right? Ultimately BlackRock is a very powerful entity in American politics and American life. And when he went on record to say that he thought an Ethereum ETF made sense, we took signal from that. That was last year, and we were preparing as such. He's recently gone on record saying that it's time for a pause, and he doesn't expect any other ETFs in the near future. Larry Fink tends to get what he wants in America. And so I would love to see dozens of ETFs, personally. And I think most people in this room would love to see that. But Emperor Fink will get what he wants.
All hail Emperor Fink. So maybe let's shift gears a little bit. So, when we talk about institutional adoption, we have centralized infrastructure and decentralized infrastructure. I think maybe another dirty secret is that the DeFi ecosystem is actually really small. And a lot of institutional adoption happens through real centralized infrastructure. John, what do you think about this?
So I think a lot of the risk controls are better in place today in centralized infrastructure. And so institutions naturally gravitate towards where risk is theoretically lower. I think the DeFi ecosystem has the capability to embed all of the regulatory compliance, institutional requirements, but it hasn't gotten there yet.
Yeah.
Things like KYC, AML, transaction monitoring. That's beginning to happen now. And I think on-chain identity is helping move that forward. But I think there's actually structural benefits to decentralized infrastructure, namely around liquidity provisioning, where retail can effectively provide liquidity and earn trading fees rather than centralized institutions. So in the long run, DeFi kind of allows you to eliminate the Citadel Securities and NYSE rent takers of the world and to pass that yield back to the actual holders of the underlying asset. So I think in the long run, that mechanism is actually more favorable to the investor, but it just has to catch up from an institutionalization perspective to have the controls and have the risk procedures in place to be able to take that capital.
Dima, what do you think?
Yeah. I think in the last few years, we spent time in DeFi in sort of called MVP phase, where we had a lot of products which objectively cannot work at scale because they lose a lot of capital, they're inefficient. The whole MEV sector seems to be very extractive, but it showed the promise of what it can be. And I think the biggest blocker has been execution, which we are trying to address. And with that blocker, you can actually build viable products. The products which can replace existing infrastructure. And I think over the next few years, we'll see more of a phase how we can onboard more institutional assets, tokenize more assets, try to embed it into more DeFi infrastructure, how we can actually leverage the existing rails to power it. And that will be more of a slower phase of going through the regular hurdles, we'll actually bring it all on chain. But I think right now, we are entering a stage of more maturity. We sort of call this dot-com bubble in crypto in a way. And now it's the question of how can we build long-term viable products with that. But to me, it seems the main value prop of smart contract chains and platforms in general.
Nick, Ryan, good.
Yeah, I would just take the other side here and say that today there is the ability to have better risk controls, more transparency, and better execution on-chain than what we see in centralized infrastructure. The problems that the space has been ostracized for over the years, FTX going back to Mt. Gox, those aren't crypto problems. Those are just corporate frauds. Crypto solves those problems, right? And so if you're willing to be at the vanguard, deep down the rabbit hole, in the weeds, in DeFi, on-chain, and go through the work of doing everything on-chain, it offers just superior risk-adjusted returns.
So you think that the DeFi infrastructure right now is strong enough, resilient enough to attract real institutional capital?
Yep.
Does anyone disagree with that?
I think from a technical perspective, there are constraints mathematically for the applications of Solidity, particularly from the Ethereum ecosystem. There are some things that just can't do as well as you can run from an off-chain risk and parametric perspective. But I don't disagree with the sentiment that the current state, I think there are many things we can do to improve that, but I agree that in the current state, they certainly receive significantly more institutional adoption than it is getting right now.
So what's an example of something that you can't do on-chain that centralized infrastructure solves?
You just can't do it as well from a cost basis perspective if you want to do high-frequency parametric modeling. and you're going to reprice and readjust.
Talk a little bit louder.
Sorry. I was chatting to Ryan all of a sudden.
Yeah.
Out of the room.
Yeah, just having a little side thing here.
I think a lot of it comes down to, and again, this is an argument for why I think Ethereum is a long-term, very interesting place to be, given that you're effectively dealing with the price to operate or own some of the block space, right? So, my apologies. The TLDR is that as the cost to complete complex actions on chain fluctuates, as you need or require the ability to run very, very high frequency repricing or rebalancing operations, Solidity in itself or creating an on-chain action to exact that can become pretty deleterious to your operating margin. With that said, there are novel and emergent techniques that can prove out the functions and outputs of off-chain models and performance that can then be posted on-chain as some verification. So right now we're in this slightly hybrid phase of finding a way to make it better, but it's a different way to slice it rather than better or worse. And there is, in many ways, and I think a lot of the discussion we're having is based around this discussion of trust. To Ryan's point, if it's all on-chain, it's transparent, recourse is very well defined. But we have good frameworks for off-chain activity where we understand how to seek out recourse, and forever we'll seek this challenge of how do we get, under-leveraged or under-collateralized lending going on-chain? That could ultimately be a huge boon for the kind of aggregate size of liquidity and performance in crypto. But without a degree of trust or ownership or knowledge between counterparties, we end up a little bit unstuck. So if I had the perfect answer, I would have solved it. I think we're all trying to figure it out right now.
John, I think you had something to say about that question Ryan asked.
Well, I think that the challenge for a lot of institutional investors is that in DeFi today, and this doesn't need to be the case, but it just broadly is today, you don't know who your counterparty is.
Yeah.
And so a lot of institutions can't engage with an anonymous counterparty. There are technologies that allow you to validate identity on chain and link that to a wallet address. They just haven't been implemented at scale yet.
Yeah.
Part of that is just a matter of user experience, right? It's a little annoying to have to go through a KYC or an AML process, but ultimately that technology is available. And when implemented, all of these things are totally
possible. So do we imagine a future where now, as of right now, we've said most of the capital, the institutional capital is coming from the East. We mostly predict that it's going to be on Ethereum or some variety of related chains, EVM compatible chains. And now we're kind of asking this question around KYC AML, right? Do we suspect that we're not going to see real institutional adoption until we have KYC chains that connect to Ethereum? Or how do we see this problem being addressed? Because it is a big one.
There's going to be centralization around identity, around KYC and AML. I mean, ostensibly, we do this. We keep on doing this in this industry where we have this really beautiful vision for this totally decentralized world. But when you get down to regulations are a forcing function for standardization.
Yeah.
In every single instance. And it's going to compel a centralization, and we're going to have to make that compromise. Otherwise, what happens is some new technology that we don't yet understand, to Nick's point, has to emerge that can allow for massively fast and verifiable, almost instantaneous off-chain compute to manage programmatic trading, KYC, AML, to do all of these things concurrently on-chain. Do we get there? Does AI factor into it? Maybe. But for today's business, we're going to have to deal with centralization if we want institutional capital to make these trades.
I mean, how do you personally address this issue with your company?
We have a wonderful structural benefit when we're dealing with, for example, a property record. One great way to figure out if somebody owns a property is to check if they paid the taxes, right? Nigerian scammers are not paying $150,000 for property taxes for 1155 Broadway in Midtown on the hopes that they could somehow steal the asset. That just doesn't happen. And so we have a massive verification benefit from their actual financial behavior. Then we're able to go and pull actual documentation, KYC and AML from third-party vendors, apply zero-knowledge proofs to them, and then prove that, for example, a group that's purchasing land here in Wyoming isn't a malicious actor. It's not a North Korean entity. It's not Julian and so forth. So, we're dealing with this in a very structural way, but it's slow. It is primarily off-chain with verifiable Merkle proofs that we can use to demonstrate that this data is valid.
Does anybody here believe that we're going to see real institutional adoption on truly permissionless chains?
No.
No?
I guess I will take the other side. Like, I actually think that in the end, permissionless chains will like win out. And I think like the ETFs are like kind of a sign of that people are interested in permissionless chain. The reason for that is that permissionless chain act as more of a neutral layer for everyone around the world, right? If you launch a KYC chain and it's like a US-based chain, it will make it harder for some parties like to adopt it. But I think what's nice about the permissionless chain as well is that each individual application can set the rules themselves. They can implement KYC on their end. Like they can even implement optional KYC. I know teams who are building exchanges with KYC flags, so they allow people like to filter out their counterparties. And that's something that we're working as well for some of the applications on our chain. And that essentially allows you to have a permissionless state, but also allows this liquidity be reused by banks or more institutional players. But I think all of this is like happening right now, but slowly. But our bet and thought process is that like it's more likely to happen on permissionless chain because there's a larger market. There's more likely you can capture more players, more liquidity, and this initial catalyst will matter a lot. And that's what can allow crypto to outcompete long term in general.
Let's remember that banks have been slow to adopt, but eventually do adopt open architecture technology, whether that's crypto and Ethereum and Bitcoin today, whether that was the internet in the 90s, or whether you go back over 1,000 years to Rhinestones and capital players and which was the original blockchain. They ultimately are smart money and ultimately will go to where the financial opportunities are, and they will deal with the regulations in their own way at their own time.
Well, let's talk about that then. So let's assume, pretty grand assumption, that institutions are smart money. Some of them for sure, but maybe not all of them. Let's assume that they are smart. We're starting to see real institutional adoption in crypto in some ways, right? We have Bitcoin ETH. Maybe now we're starting to see some cool on-chain assets, money market funds, variety of other things. A lot of people are building new on-chain real-world asset kind of offerings to institutions. I mean, John, you've spent a tremendous amount of time specifically on this topic, and it begs the question, do we think that institutions are going to come on-chain and they're going to participate in markets that were already liquid? Do we think they're going to come on-chain and make previously illiquid markets liquid? I mean, John, how do you think about this?
I mean, I think the real promise of blockchain, the most exciting part, is taking things that aren't liquid today and bringing liquidity to them, namely private assets, things like venture capital assets, private equity assets, real estate. The other stuff, already exists broadly in a liquid form, whether that's, a treasury ETF or a public equity. And so putting it on chain expands its distribution, but it really doesn't offer a new product to the market or a return, of an asset class that they can't currently access. I think like the big unlock is when you take an asset class that's exciting, like private equity, that has a higher return profile than people can access today. You put it within this infrastructure that's global, accessible, and my view is that DeFi will make it more liquid than centralized exchange trading. And I think now you have a radical improvement, in accessibility to these types of instruments that will benefit both funds, so they can recycle capital, return it to their investors and redeploy in the primary markets, and investors who now have, access to a higher return asset class. And particularly for smaller investors or even high net worth individuals, family offices, liquidity in those assets is really critical.
Yeah.
And today, when you buy those things, you're stuck for 10 years.
Totally. Yeah.
And it's really just, it's not that favorable. And so it does provide a fundamental improvement in market structure for those types of products once people are ready.
Yeah. I mean, I would love to be able to take some LP stakes in a variety of funds that I have and use that as collateral to take out a variety of loans. Right now, you can't really do that. I mean, that to me has always been one of the North Stars for this.
And I think you look at a market that's north of 10 trillion of assets. It's all paper.
Yeah.
There's really no digitization, blockchain or otherwise. And so I think it's only a matter of time until you can perform those other functions, lend, borrow, provide liquidity to facilitate trading, these types of things, which also enhance your returns.
Yeah.
Right. So by making it composable, now you can actually boost your return on top in a fundamental way.
Yeah.
And so I don't think, smart money is going to leave that on the table once they understand the mechanics.
Yeah. Anyone else have any thoughts on that? John, I mean, I know you've thought a lot about what it means to put real estate on chain, or how do you think about that? How do you think about what John just said?
I mostly agree with what you said, John. It was nice to hear, actually. But I think liquidity really changes the asset class. If we're talking about real estate with liquidity and real estate without liquidity are not the same asset.
Yeah.
Entirely new trading vectors emerge. We have no idea what that might look like. But just to give you an example of how different a liquid real estate asset class might look, imagine if we owned this building, okay? And we had a tenant. Today, it's a black box. They pay us the rent. We expect that things are going well because we're cashing checks. But now imagine that this is a completely liquid asset with a completely liquid capital stack, and we have real-time data on the energy usage of the space, and we see for the last 6 months, they haven't been using electricity. And the market sees that they haven't been using electricity. What does that do to the cap rate for this asset when we endeavor to hypothecate it or to sell it outright? Right? Completely new trading vectors emerge as a result of liquidity and transparency that totally change the asset class.
Yeah. I mean, I completely agree with that. The pushback, right, that I think we see when we talk about things like tokenizing, let's say LP positions in funds, is that the operators, the LPs, the investors, right, they don't want that, right? They don't want their fund valuation to be freely trading all the time, their NAV to be kind of open and available to the public. How do you counter that?
It's not their choice. Mr. Market is going to tell them what they want. And people who like to make money do things that people who want to give you money ask you to do.
Yeah. John, what do you think?
Well, I think it'll first take the form of end-of-life funds, right? Where the fund manager's incentive is to monetize that position. And so they're willing to accept the liquidity in order to take that capital back and return it to shareholders. And, my thesis is that outweighs, the negative aspects of some more transparency. But I do think it suggests that this will start at later stage assets where pricing is more certain, and there's more consensus around.
That'll also probably be a compelling quality filter. I've gone on record many times saying I wish that all venture capitalists were forced to publish the returns, because we would do away with so many pretenders in this game so quickly. And and if that transparency comes about in the push for liquidity, which ultimately a lot of GPs hold expressive LP components of their fund, or your GPs should have expressive participation in their own LPs, the cream will rise up because they have nothing to hide. And I think that's what we've seen, play out in the history of the space, is that the people who have nothing to hide, who are building in the light of being on chain, end up doing well all the time. And I think that will unlock great value for the people who value should be unlocked.
Anyone have any opposing thoughts or anything to add to this?
I think we're all here because we believe there is a next leg, a next arc for more transparent, more effective ways in which we manage and distribute assets, whether that be in the form of generating new liquidity cycles for what have historically been fixed assets, or thinking about shortening liquidity cycles for private opportunities. But also finding access to things that other people previously have not had access to. We care a lot about looking after retail. And we started the week after FTX collapsed. And one of the rationales for that was that we looked at the on-chain performance on recourse for debt that was created by FTX, and it was made whole instantaneously. We knew that those who even transacted with FTX out in the open were made whole day one. And our thesis was, how do we create access to that type of performance, that type of transparency for anybody who is willing and wishing to come on chain and transact with us? And I think that's like a core tenet of how at least we operate and run our business.
So in the last 2 minutes here, let's kind of end with one kind of quick fire response. I would love for everyone to answer the following three or four questions. 1, what is the price of Bitcoin going to be in 2030? 2, what is the price of Ethereum going to be in 2030? 3, what is the sum total value of assets on chain? 4, what is another bold prediction that you have that you want to share with everyone here? John, go.
What's the Ethereum price today?
That's like
2,500.
2,500. Bitcoin will be above 100,000. That's
okay.
The only conviction.
Very conservative.
Yeah, above 100,000. Ethereum above 4,000.
Okay.
And sorry, what were the other two?
Total value of assets on chain.
Total value of the assets, not inclusive of real world assets?
Yes, inclusive.
5 trillion plus.
Any other bold prediction that's relevant to institutional adoption of crypto?
People are going to be able to access private equity funds on chain.
All right. Dima, go.
Yeah, 200K, 10K. I would go 10 trillion. And I guess for the other prediction, we would see active equities trading on chain.
Nick.
Similarly, I think somewhere between $200,000 and $250,000 for BTC, somewhere between 8 and 10 for Ethereum. I think that should net us somewhere in the realm of $10 trillion of assets. If we unlock real world assets and real estate specifically, that number gets a lot larger. My prediction or my thought process here is that before we start seeing adoption of sophisticated financial instrumentation of chain in a commoditized fashion, we'll start to see more adoption of retail participation through brands, household brands, companies that we all live and breathe today that are sitting on your shelf at home will start to adopt ways of tokenizing their inventory.
So 2 observations I make from this week. Having the opportunity to quickly listen to Senator Loomis was remarkable. Those of you who are residents here have a wonderful senator. If she gets her way and the U.S. is able to acquire the strategic reserve, we'll see Bitcoin be north of 500,000, I think, pretty conservatively by the end of the decade. And she seems to be smart enough and high conviction enough to get that through. That for investors on a relative basis, that will matter because Ethereum will be north of 30,000. You'll note that every prediction here has Ethereum outperforming Bitcoin over this 6-year timeline, which I think is interesting. There's a lot of headlines about the fact that Bitcoin will go above 100,000. But if you do it on just pure X performance, Ethereum is probably going to outperform over the next 4 or 5 years. That's not anything against Bitcoin. That probably brings us to the overall. Well, actually, quickly, I think $10 trillion of assets is a relatively conservative number there and reasonable. But bringing us to a prediction coming out of this event that Senator Loomis will get the strategic reserve through a Bitcoin, which is akin to your gold strategic reserve. But we'll take it one step further here to make it a bold prediction. And she'll also get something akin to your strategic oil reserve and have a strategic Ethereum reserve by the end of the decade.
Love that. Bold. John, over to you.
Yeah, I echo your point. I think, predicting Bitcoin and Ethereum price is kind of a parlor game. The important detail here is I absolutely agree Ethereum outperforms Bitcoin over that period, which is far more relevant, I think, to people. In terms of predictions on, my big hot take here on where this go, I kind of want to echo this. I really do believe that we have orders of tens of thousands of chains by the end of this decade that are operating as legitimate L1s with no coupling whatsoever to Ethereum or any other existing L1, and nobody cares.
Yep. All right. Thank you all for joining for this panel. Thank you all for listening. It was a lot of fun.